Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, hi everyone. So today we have two different things to do. The first is to finish off those last two slides of Lecture 2, and the second is to start and finish Lecture 3. This isn't a particularly long lecture. It's moving a bit more into the technical side, but it's essentially an introduction to our asset allocation task. So I am committed to finishing the lecture within the 2 hours, but just to emphasise what I put up on Wattle, the way I like to do things is I like to give a lot of examples to answer questions. I don't ever want to rush through slides. So as a result, I may spend time in the workshop covering it, but I will never examine you on something that I haven't had time to cover. So I don't want you guys to worry that I'll race through any slides and they'll end up in the exam and we won't have discussed it. I'm going to take my time to discuss everything because it's important, and I'd rather you guys learn the most important stuff deeply than try to learn a bunch of extra slides just for the sake of it. So don't stress if we end up taking, like today, if a couple of slides end up skipping over to the next week or into the workshop. I'm not going to therefore race through anything else. So always ask me questions, always take the time to make sure you understand. So if you remember, we started in week 1 by saying that the optimal portfolio will depend on the investor. So you can't do anything to do with asset allocation without understanding your investor, who they are, what they want out of an investment. So the first thing to do is to understand investor objectives. That will affect their perception of risk and the risks that they face. And once you understand that, then you can go about designing a portfolio that's right for them. Where we finished at the end of last week's workshop was talking about some of those additional risks that traditional mean variance analysis doesn't pick up. And we finished halfway through our discussion of liquidity risk. Remember, liquidity risk is the risk of taking either a haircut or being stuck with a perm. Remember, a haircut, if you're trying to sell an asset, a haircut is that you will sell the asset for a price higher or lower than what you'd hope. Lower, right? Because you want to sell for as much as possible. Unfortunately, if there aren't enough buyers and there's an oversupply or there's illiquidity in the market, to persuade someone to buy it off you, you need to take a cut in the price. If you're trying to buy an asset and there's a lot of demand but not a lot of supply, or you need to convince someone to sell it to you, a haircut would be the reverse. You pay too much, more than you'd like. A perm is that dangerous scenario where you can't trade at any price. You are stuck with a suboptimal allocation. And that's the scenario that can often lead to collapse, as it did with long-term capital management. By the way, speaking of long-term capital management, do you guys remember last week when I said that it had the ideal makeup or composition of people, right? It had Nobel Prize winners, it had John Merriweather, and I kept on trying to say, that basketball thing, that's what it's like, and you guys looked at me like I was crazy. Yeah, it's not. It's fantasy football, right? It's the idea of fantasy football where apparently they decide, okay, well, if I was going to have a football team, who would I put in it? I was out to dinner over the weekend and I said, what's that basketball thing where, you think about your dream team, and every guy at the table was like, are you talking about fantasy football? I'm like, yeah, that. He's like, they're all like, yeah, different sport, not the same. But anyway, so long-term capital management, like fantasy football, had all of the best people you could want in that fund, but it still went under. The issue is essentially when you're in a crisis, whether it's your own crisis like long-term capital management found with the Russian default and the trades that therefore diverged instead of converged, or whether it's a GFC and it really is systemic, like the credit markets, where everyone wanted to borrow, no one wanted to lend. A perm is when you want to transact, but you can't. So we finished with a discussion of this slide. The other thing I wanted to take you through is covered in your examinable readings for last week, but I wanted to talk about it quickly now because it links back into the fact that illiquidity can be difficult, but it doesn't need to be a deterrent, depending on what the situation is that you face. You can split illiquidity risk into three different regions. The first is where you'd like to be if you're dealing with illiquidity, and that is where you want to trade, you can trade, but it's going to cost you, right? So if that's the case, you say, all right, well, I want to sell an illiquid asset. I know I can. Is it worth doing it? So here's an example. You have a 6% private equity weight in your portfolio. That 6% is split up equally between two different funds. One of your private equity funds you're really happy with. The other private equity fund you've held for about 4 years. You're past the bottom of what we call the J curve, and we're going to come back to that when we look at private equity. But in other words, you're starting to get some return back, but you're starting to realize that this private equity fund isn't what you'd hoped. You're not happy with the investments they've made. You're not happy with the performance. So you'd really like to sell that 3% private equity stake in this particular fund. But the private equity secondary markets aren't liquid, so you'd have to take a discount to the net asset value for the fund. Region 1, what you're saying is, I'd like to get rid of this 3% stake. I will have to take a discount to net asset value. So what do? Do I stick with a 3% stake in a fund that isn't performing very well, so it will hurt my performance? Or do I sell it but take a haircut on the sale, which will also hurt my performance? Which is worse, right? So it's not ideal in that you are going to have a cost in some way. It's the cost of existing with a suboptimal portfolio or the cost of taking a haircut. But you do have the choice, and so you'll choose what minimizes the cost to you. The second region is worse, but it's not a killer. And it happens actually quite often. In the second region, you can trade the illiquid asset, but you don't have the choice. You've got to trade it. You're glad that you can, but you have to do it. So let's say that you guys are running a multi-asset class fund, and in your mandate, right, which are the rules that you need to adhere to, in your mandate is a constraint that you can invest no more than 30% of your fund in illiquid asset classes. Now, you started the year pretty close to the constraint, but okay, you had 28% of your fund in illiquid assets. Now let's say that the Australian and world equity markets drop. Let's say that fixed income markets fall as well. But maybe because of appraisal valuation, so they haven't caught up, or maybe just because property is not perfectly correlated with equity, for example, your direct property weight, your direct property performance is strong. Okay, and now let's say that direct property is the entirety of that 28% of your illiquid assets. So what happens? Your equity performance plummets, your fixed income performance plummets, your direct property performance stays stable. What will happen to your direct property weight in that portfolio? It's going to go up, right? Not because direct property is doing better, but because the other asset classes are going worse. So you were at 28% illiquid assets. Suddenly, you're at 35%. If your mandate says you have a maximum of 30%, you have to get rid of 5% of that direct property stake. It's in your mandate. That falls within the second region. You have to take a haircut, but it's a haircut you're going to take to comply. You might even want to sell 6% to get you so you're not smack bang at that mandate, right? Because if you're at 30%, it only takes a tiny move to violate it. And that's something you guys are going to consider in your assignment. I will give you a maximum on illiquid asset classes. And you might, one of the things you might ask yourself is, well, the optimizer is telling me to go to the full maximum, but does that give enough breathing room, or might I want to have a little bit of space in between the maximum and my allocation? The third region is where you never want to be. That's where you have to trade. You've got no choice, but you can't do it. And that happened in the GFC, it happened to long-term capital management, and that's when your business can be at risk. You could go under. Right? I mean, let's say that you have to trade, you're violating a condition, but you can't do anything about it. Your investors get unhappy, they leave quick. You're still violating because you're having to sell other assets at a loss, but you can't sell the illiquid assets to meet the requirements. The chances are your fund's not going to survive. So don't avoid, remember I said this at the end of the previous slide, illiquidity is difficult. It's a pain to deal with, but it doesn't mean you should ignore illiquid assets. They're great diversifiers and they can give you an uplifting return as well. Some of them are also very good on the risk perspective. Infrastructure, if you pick the right infrastructure project, can be a great diversifier with low risk, stable cash flows. You need to deal with the illiquidity. It is complex to analyse, but you just need to keep it in mind at all times. It doesn't mean you should ignore it altogether. Avoid the asset altogether. You also shouldn't ignore the risk, but you shouldn't avoid illiquid assets necessarily. Now, the last risk I wanted to talk about is peer risk and regret. And they are often one and the same, particularly if you're a relative return investor. Because if you're going to underperform your peer group by making a major decision, chances are you're going to regret that decision. So what I have here is a relative performance between Australian versus world equities, 12-month performance. So every time the green line is above zero, so above that red bar, that means that Australian equities are outperforming. Every time it's below, Australian equities are underperforming. Now, the first thing to note is that historically, and we'll talk about this in the third lecture today, historically, home bias has been a problem right across the world, and particularly in Australia. How would you guys, does someone want to offer, what would you say roughly you would define home bias as? If I say a portfolio has a home bias, what does that mean? Yeah, for us, that's right. It means that you have an overweight in Australian assets relative to what something like modern portfolio theory would imply. Right? Modern portfolio theory, you're supposed to have all the assets that exist in the proportion they exist. Australia is a tiny proportion, like 3% of the overall equity market. And yet what we see in reality is that a lot of institutional superannuation funds, and institutions, remember, are experts. Even they have, say, 2/3 of their equity weight in Australia. Ordinary retail investors, the home bias is even higher. Now, there are a lot of advantages in reality. Forget modern portfolio theory. In reality, there are some big advantages to holding Australian shares. Familiarity, ease of access, and particular, we're in a dividend imputation system. So we can get access to franking credits that give a massive boost to our returns. So I'm not saying that we should all hold 3% of Australian equities. But even when you take account of the advantages, it seems like our equity weight in Australian stocks here is too high. Right? It's hard to justify 75% weight in Australian assets. But what we find is that that is what tends to happen in the industry. It's slowly evolving away from that. But it means that the majority of big funds, the majority of your competitors, say, are going to have a big home bias in Australian stocks. Let's say that you guys want to be the ones that correct that home bias. So you're therefore going to want to sell some of your Australian stocks and purchase world equities instead. Now, when you do that, you're going to take on a huge amount of peer risk, right? If the average superannuation fund has 75% of their equity weight in Australia, let's say that you just want to go down to 60%. That's a massive difference in performance. And we're going to see that when we look at our equities in a few weeks. If you take on peer risk and you have member investment choice, if you correct the home bias, but Australian stocks outperform, you're going to go down in the league tables, you might lose your investors, you might need to sell more stocks, you might need to unwind more positions, that's going to hurt your performance more, you'll drop further in the league tables, and so it spirals. So you've made a sound decision based in theory, based in reasoning, but if you're wrong, you're not just doing worse than you would have done, you're doing worse than your peers, and you might lose your clients as a result. Now, if you have a look, particularly in the 2000s, That's a situation that you really did face because, yes, there's a massive home bias, but Australian equities were going great guns in the 2000s. Not so much lately. It's been a bit more volatile. But imagine correcting. Imagine in 2001 thinking, yeah, you know what, I'm going to do the right thing. I'm going to correct this home bias. And then going through a decade of going, damn it, damn it, damn it, damn it, why did I do that? And that takes me to the last one, which is regret. Right? If you're going to make a big deviation from your peers or a big deviation from what you had planned, you're going to undergo regret risk. Right? So if you've been planning on doing something for a long time and you change your mind at the last minute, you don't ever want to look back and go, oh, why didn't I stick with that plan? So as a result, that can make people quite hesitant to take major changes. It's another thing that it's really difficult to factor into a quantitative model. Peer risk you can, because you can have tracking error constraints, and we'll look at that later today. Right, so remember, all of these risks that we looked at last week, investment horizon effects, like positive and negative serial correlation, they're things that modern portfolio theory doesn't take into account of. Right? They don't look underneath the surface to understand the causes of the risk. So what we're going to do for the rest of today is we're going to look at the start of asset allocation. We're going to talk about why it matters so much, what it is to begin with, and then we're going to look at the most popular form of asset allocation technique, which is, it comes straight out of modern portfolio theory, and it's called mean variance optimization. But what we're going to do is we're going to start with the theory, then talk about the problems with the assumptions underlying the theory, and then talk about what therefore won't work in practice, and finish with what will work in practice. Because what we're going to find is you don't want to throw modern portfolio theory away. It's given us enduring messages that we didn't know before Harry Markowitz came up with that efficient frontier. But you don't want to follow the theory to the letter either. So that's what we're going to do today. We're going to go through we're going to gain a broad appreciation of the asset allocation task, both the science and the art. So just quickly, what is asset allocation? What are we doing with the asset allocation task? I've got a pot of money. Invest in the different asset classes. So I've got a fund with $1 billion. How much of that am I going to put in debt? How much in equity? How much in my alternative asset classes? When I say that we're going to understand the science and the art, what I mean is that asset allocation isn't going to be as simple as just applying a scientific formula or model. Right? You need an overlay of common sense, intuition, and what I call sense checking the output. The way that I'm going to show you this as we go through the lecture is by talking about mean variance optimization through something called Solver. Solver will do everything it can to give you the best possible portfolio based on the numbers from what you've asked it to do. But it's a computer. It can't sense check. It doesn't have that overlay of common sense and reasoning. So it can't look at the portfolio that it's ended up with and said, is it feasible? Is it sensible? So we're going to look at how to, if you want to use optimization, make it into a more realistic solution. And so in doing that, we're going to actually look at different ways to apply the mean variance model in practice. So to give you guys a bit of context before we start, let's talk about why the asset allocation decision is so important. Does anyone know what's happening in a few weeks' time? In a few weeks' time, we're about to potentially hit a record, particularly to do with the S&P 500. Does anyone know what it is? Did someone say something? It's in the news at the moment. People are watching it carefully, and I personally believe that the markets know that our equity week is in 3 weeks' time, and so therefore I'm able to tell you guys whether we've hit this record when we finally do reach our equity week. Sorry? Oh, actually, it's not the one I'm thinking of, but that's another massive thing that's happened. What happened with Apple? $1 trillion. Look, personally, I was one of the people that would say, when Steve Jobs passed away, forget Apple, you know, what are they going to do? But look at that, $1 trillion. This is crazy. I mean, that's something that I didn't think was going to happen with the speed that it did. There's actually another thing. There's 3 things that are going on at the moment. Apple's hit $1 trillion. Everyone's also talking about a 10-year anniversary in the middle of September. Does anyone know what that 10-year anniversary is? I think I heard something, but I didn't hear what it was. GFC. It's the anniversary of the fall of Lehman Brothers that triggered the GFC. That's right. So the other thing that is coming up, or may be coming up in a few weeks' time, is that a little bull is going to achieve its longest sprint. We are potentially at the cusp of the longest bull market in history for the S&P 500. Okay, so this is a really exciting time. Now, there is argument as to whether this is the best measure of a bull market, but have a look. In less than 3 weeks, and I'm pretty sure this article was today, it was either today or yesterday, in less than 3 weeks, the current bull market will rank as the longest of all time, right? Eclipsing the climb that spanned most of the 1990s. So, I mean, the recovery from the GFC was not a boom when you were in it, right? I mean, it felt like things were really stumbling. The job market never quite recovered. We had all the problems with the euro. There's a few political problems that I could mention in a few different countries. But we have been climbing, and climbing for a long time. So what's popping out of the ground, if you like, are 2 different camps. People that think, all right, long enough, and people that think we're strong. Some people are predicting that we're going to continue to grow, and more you're starting to get the opinion pieces saying, okay, this is as good as it's going to get, the market's going to crash. By the way, really famous people in the last week have been saying it, and they never say when it's going to crash. They say it's going to, but never when. And I heard a great quote from one of my colleagues yesterday, and that is that a broken watch always gets the time right twice a day. Right? You can say it's going to crash, and as long as you stick to that story, I promise in the next few years you're going to be right, but it's how long it's going to take. So given that, right, we're so close to the longest bull market in history, I'm going to give you 2 potential portfolios. One has 70% in equity. Okay, this is a really uneven pie chart. What am I doing? Let's try that again. There we go. 70% in equity and 30% in fixed income. One is 50% equity, 50% fixed income. Now, don't worry about, I'm going to break my own rule here and say don't worry about your investor objectives just for a moment. Think only about what you believe is going to happen in equity markets over the next year. You've got a time horizon of a year, and you're going to choose between these 2 different asset allocations. Now, by the way, I have no idea what's going to happen. There is no right or wrong here. But if you're willing to offer a show of hands, who would pick the 70% equities at the moment? Yep, there's a couple. Who would pick the 50% equities? There's a few more. So we have a few more people that believe that really the market is getting towards a peak. A year from now, it won't look so positive as it does today. I don't know what's right. I didn't predict the GFC. I know I won't predict the crash this time either, unless I keep saying it's going to happen and not say when. But what I wanted to drive home is this decision, this one decision. If you think about the people that said they'd pick the allocation on the left versus the allocation on the right, if I was to tell you all of the different reasons that would cause one group to outperform the other, about 40% of that, nearly half of the reason, is that one decision, the asset allocation decision, right? You might outperform because one of you picked Combank and one of you picked Westpac, but it's not going to have a big effect. Maybe, I mean, you're asset allocators, so all right, maybe one of you picked Rio, someone picked BHP, someone picked Fortescue. It's going to matter, but not that much. What is going to matter between cross-sectional difference in performance is this decision here. Now, hopefully you guys will be more diversified. You won't just hold equity and fixed income. You're going to hold a lot of different alternative assets. You'll have some weight in cash. Hopefully you'll be both Australia and overseas. But the point is, the asset allocation decision has a massive impact on the relative performance of your portfolios. So when you're in that league table, 40% of where you're going to sit is going to come down to this decision. The rest will be things like stock picking, style, market timing, taxes, but that's massive. Even more massive is that if you take your fund, so don't worry about anyone else right now, just think about your fund, the decision you made here. 90% of the time series variation in your performance is going to come down to this decision alone, right? So the volatility of your fund through time, if you ran a regression to look at the explanatory factors, 90% of it can be explained by the asset allocation decision, right? This is massive. So there's a reason that we start with asset allocation. Execution, stock selection, it matters, but it's not as influential to performance. So hopefully we're starting with me being able to convince you guys just how much this decision is going to matter. Because we're now going to spend the next 3 weeks, this week through to the end of week 5, talking about different ways that you can decide an asset allocation for the fund. And that decision is going to be the focus of your group assignment, which you'll get either in week 5 or more likely, probably, you'll get it in week 6. Because in week 5, you've still got a bit to learn. I don't want to give you the assignment when you don't have an idea of what it might involve. When I say choose an allocation method, I want you to know the different allocation methods out there. So to give you guys a bit of an overview before we start going down into the technical detail, here's some things that are important to know before you start to approach the task. The first we've just said, how important it is. 40% of the cross-sectional variation, 90% of the time series variation is going to be because of asset allocation. The second, I've also said today, we learnt last week, we learnt in week 1, and that is objectives are central, right? Objectives will affect your risk preferences, which will affect your asset allocation, right? In every class, I think that or in every topic, there's sort of that one line that will probably get you 1 mark if you walk in blind and write it on the exam, right? Foundations of finance, higher risk, higher return maybe, or buy low, sell high if you think about the arbitrage topic. Probably in this course, if you went in and wrote objectives are central or everything needs to stem from your objectives, your marker will probably smile and give you, well, they may not, but they may give you 1 mark because everything in this course comes down to that point there. You cannot figure out the asset allocation until you understand your investor. The next point you guys might have looked at in investments or applied investments, but I wanted to take you through it just in case. And that is that without going into the method of allocation, you can broadly split it into 3 camps: static, dynamic, and tactical. Have you guys looked at that in investments before? I'm not getting a lot of nods. All right. So essentially, you can call them static versus time varying. Static asset allocation is the static one. Time varying is either dynamic or tactical. If we start with static asset allocation, which people will often call static strategic asset allocation, or SAA, this is our unconditional asset allocation method that's always with the long-term view in mind. Remember how we said that there was a holding period last week? Static asset allocation focuses on your holding period. So what it does is it says, who is my investor, what are their objectives over the long term, over the holding period? And then it says, all right, what is the long run average performance of the different asset classes over the same period? So maybe 20 years. And it aims to create an asset allocation now that matches the long-term objectives of the investor with the long-term average performance of the different asset classes. So you're investing today for that 20-year goal and not for anything in between. So that's why we say it's unconditional. We're not conditioning on changing investment opportunities. We're not conditioning on the fact that investors change through time. We're just focusing on the long-run average performance and the long-run goals of the investor. Now, that doesn't mean it's a case of set and forget, right? You would review it every 3 to 5 years, but always with that long-term view in mind. So static asset allocation has probably been around, it has been around the longest. But What it doesn't acknowledge is that you may look at the average long-run performance of the different asset classes, but they're not going to sit there earning that long-term average all the time, right? Investment opportunities change, and investors change. So what dynamic asset allocation does is allow for both of those things to occur, and therefore, even with a long-term view overall, actually still be adjusting your allocation in the medium term, conditioning on changing investors and investment opportunities. So dynamic asset allocation is what we call a time-varying method of asset allocation, because you're tweaking your allocation through time, and it is a conditional method of asset allocation, right? Conditional on changing investments and investors. So, for example, you might look at changes in asset risk return profile, in investor horizon, in investor preferences. Let's start with investor horizon. I gave you guys an example of a particular type of fund that is conditional on investor age. Does anyone remember what that is? Life cycle fund. So what does a life cycle fund do? Yeah, in what way? Yeah, perfect. All right, so if you have a life cycle fund, you are conditioning on investor age. It's a conditional method. And what you're doing is, as the investor ages towards maturity, you are de-risking. You're dialing down your weight in equities. You're dialing up your weight in fixed income. So that is a method of dynamic asset allocation. Now let's stick with the investor for a moment and have a look at preferences. Preferences or even circumstances. Let's say that you guys have been fund managers in an active Australian equity fund for the past 20 years. That is a tough business. It is a high-risk business. So if you've got a lot of your job risk tied up in the Australian equity market, when it comes to your investment portfolio, what might that do to your equity, Australian equity weight? Sorry? Less, right? If you want to diversify away the risk in the job market, in, say, your super fund, you may actually choose to reduce your weight in Australian equities because you've got job risk there, so you're going to take some investment risk out of there, right? It's a diversification across your asset classes. It's just it's not all within the portfolio. It's also within your career. Right. Now, some people might argue, well, if I'm an active Australian equity manager, I am going to invest in active Australian equities because I'm good at it. But we're focusing on the risk side of diversification here. Okay, so you've been in the active equity job market now for 20 years. You've had a good career, but you're starting to feel like the stress is getting to you. You haven't had a holiday in the past 2 decades. You've now got a family you want to spend some time with. So you've decided, you know what, I'm going to go out and I'm going to get my PhD and I'm going to be an academic. And I'm still going to research Australian equities. There might be a lot of research questions I've wanted to take 3 years to learn, but who has the time if you're a fund manager? So you now become an academic. As an academic, do you think that our job risk is as tied up in the performance of the Australian equity market? It's not, right? I mean, in fact, if anything, crashes give us things to research. We have other risks, but they're not as tied up with the job market. We're not cheering when the market goes down, but we're not as worried as other people are. So, if that's the case, my job risk into, oh shit, that's me. Sorry. I was like, who's got their blinking phone on? I do. All right, my job risk isn't as intensified in the Australian equity market. And remember, I'm a good Australian equities investor. I had a 20-year career at it. So what might I now do with my Australian equity weight in my investment portfolio? You can afford to increase it, right? So that's one. Let's stick with this same investor. All right, so you've retired, you're spending time with you haven't retired, you've switched careers, you're now spending more time with your family, and you're starting to get a little bit more risk averse, right? You want to make sure if anything happens to you, you're going to have enough in your portfolio that's going to help your children, for example, when they inherit. Right, so that's another thing. You might have been really aggressive, really high risk when you were younger. You felt invincible, you didn't have a family to support, but now your risk preferences are changing. You're becoming more risk averse. That's going to affect your asset allocation. Right, so it might be because you changed career. And by the way, apparently, I looked it up today, we're supposed to change careers an average of 5 to 7 times in our lives. I don't know anyone that's even changed, I don't know, well, maybe once. I don't know many people that have changed twice, but apparently 5 to 7 times. With each change, that might change your asset allocation. If you become more risk averse, it will change your asset allocation. And people are shown to become more conservative as they age. That will fit into a dynamic strategy. The other thing is that asset risk and return, the investment opportunities themselves can evolve through time. I think I told you guys last week or the week before that my mother is particularly risk averse. Now, let's say that she had a small weight in gold in her portfolio back in the 1990s, right? Gold is a really good safe haven asset. It doesn't erode or tarnish or wear. It has implicit value in a way that money doesn't, right? Currency is only as good as the government that backs it. It's paper at the end of the day, or plastic. Gold is a safe haven. So when financial markets tend to worsen, there tends to be a flight to safety and the demand for gold increases. But back in the 90s or the early 2000s, if you invested in gold, you would have to store a bunch of gold bars. That is inconvenient and difficult. So there was a constraint to the ease at which you could invest in gold. Does anyone remember from last week when the first gold ETF was created? 2003. Right? 2003, we had our first gold ETF. So imagine that you're in a position like my mum. You're very risk averse, you want gold, and suddenly you can get a lot more of it. So now your investment opportunity set has changed. You may wish to increase your asset allocation towards safe assets like gold, because you can. We have now a lot of passive indexes offered as ETFs. We have a lot of commodities traded as ETFs. So what you can trade can change. Here's another one. An asset class that's been around for a long time, but its risk profile has changed, is emerging markets. Let's say that 20 years ago, you invested in emerging markets because it had a low correlation with developed market equity, and therefore you saw it as a good diversifier that also had a nice bit of uplift in returns. What we then saw is that emerging market correlation with developed markets increased through time. So through the 2000s, in fact, particularly up until about a couple of years ago, the correlation between emerging market equities and developed market equities was going up. Actually it was getting closer and closer to 1. That is a change in investment because suddenly emerging market equities was not as good a diversifier anymore. So you may want to reduce your weight as a result. But over the last couple of years, we've actually seen a decoupling in it again. And there's a reading that I'll put in your supplementary folder for your equity week that's going to talk about that. So now emerging equity markets is again becoming a good diversifier for your developed equity markets, which means you may want to increase its weight if you like the risk-return profile of emerging market equities if it fits your objectives. Okay, none of this can be accounted for by static asset allocation because you're looking at a long-term average, whereas dynamic asset allocation, you're allowing your opportunities to evolve. Both static and dynamic asset allocation are what we call base methods of asset allocation, in that if you're looking at what's right for your investor, you will pick one or the other. If you're focusing on your investor objectives, you do not pick tactical asset allocation as your overarching method. I want to make that really clear. So in terms of similarities, both static and dynamic asset allocation focus on the investor, just in different ways. Both dynamic and tactical asset allocation are conditional methods of asset allocation, but tactical doesn't focus on the investor. As a result, tactical asset allocation is not typically used in isolation. What a fund might have is either a static or a dynamic asset allocation policy in general. That's going to set the broad weights, and then they'll deviate around it a little bit through to tactical asset allocation. Tactical asset allocation is market timing, pure and simple. It's trying to pick the trends in the market and trade on them before they correct. So it's like getting a little bit of uplift, a little bit of alpha in your performance. So let's say that your Australian equity weight is 35% due to either dynamic or static asset allocation. You might then allow your fund manager to change that 35% to either anywhere up to 40 or down to 30 based on tactical asset allocation views, right? So you're not setting the broad allocation based on tactical views. You're just deviating from your baseline that little bit. So if you are sitting at 35% and you think that over the next year Australian equity market is going to rise, what would you do to that weight? You take it up before it does. You might go up to 40%. But if you think the Australian equity market will fall, you might dial it down to 30%. You can't get rid of it completely with tactical asset allocation because your fund has given you, for example, 5% leeway either way. But within that range, you'll start to change your allocation based on your short-term view of market trends. Now, you don't need tactical asset allocation. If you're not good at picking markets, don't try. You're just going to do damage to your portfolio. Okay, it is a unique skill. It's a very rare skill to be a genuinely good market timer. So a decision will need to be made on static versus dynamic asset allocation. But when it comes to tactical, it's more, do I do it or not? And you don't rush to do it if you don't think that you have that genuine skill in picking markets. And by the way, a lot of people think they have the skill, less actually do. And the last point I wanted to say, to get you in the right frame to go into some of these methods, is that the role of models are tools for analysis, but they should never make the decision for you, right? A computer cannot sit there and say, well, for example, my investor has a 10-year horizon, but they're going to monitor my performance every 6 months, right? A computer's not going to be able to tell you that. A computer's not going to be able to say, oh, all right, some of these qualitative risk factors are picking up that are similar to a past market crash. You need human oversight and judgment. Even the best quant funds don't make a decision just because a computer tells them to. You always have to actually say, does it make sense? If it doesn't make sense, you don't do it. And we'll talk about things like error maximization later on. So, to go into mean variance optimization, we're going to start with the theory, then talk about why the theory kind of sucks, and then what we're going to do to fix it. This is modern portfolio theory. It's a beautiful theory. Harry Markowitz did a lot for finance when he came up with it. There's a reason he is a Nobel Prize winner. But there's a few problems in terms of applying it in practice. Now, before we talk about the assumptions, let's talk about what we see, since it might have been a while since some of you guys have actually done this. This blue line, does anyone remember what it's called? Efficient frontier. That's right. What is the efficient frontier? What does it show? First of all, is it all risky assets or risky and riskless? Risky only, right? So, if I say that they are the optimal combinations of risky assets, forget about borrowing and lending for a tick. What do I mean by that? Yeah, that's right. So for every level of variance, it's at the highest possible return. For every level of return, it's the lowest possible variance or risk, right? So if you say, it depends which way you want to say it, but if you say, I'm willing to take a standard deviation of 10% per annum, you then go to this efficient frontier and it will give you the combination of risky assets that gives you the highest possible return for that level of risk. Or if you say, I need to meet a return of 12% a year, but apart from that I want to minimize my risk, then you're looking for 12% and you find the point on the line that gives you the lowest possible risk. Right, so from the minimum variance portfolio up, the minimum variance portfolio is what? The combination of assets that, it's in the name, minimizes your variance, right? From the minimum variance portfolio up gives you all mixes of risky assets that gives you the highest return per unit of risk or the lowest risk per unit of return. Yeah. No such thing. In terms of Markowitz's frontier? I mean, in terms of when he wrote the theory? Or? Yeah, yeah.
Is it decided by the cost of the market, or is it just building that?
That's actually a really good question. It depends which way you want to look at it. So what the theory itself said is, in a way, it is decided by the forces of the market, because that line is going to comprise all assets that exist, and therefore the market, if the market has a demand for an asset, it will exist in a greater proportion, and therefore it will affect where it sits along the line. But in reality, it is determined by theory. It's ignoring the market forces in terms of what you can access. It's looking at what does exist. So it does depend on supply and demand a little bit, in that the asset has to exist for it to appear on the frontier. But it ignores all the realities of the market in terms of some people can't access all assets, for example. And it just says, here are the assets, knowing that they exist, this is the frontier based on their returns and their risk. So market forces will affect their risk return, but it ignores all of the other things that come up in reality that we're going to go through. So it is still a theoretical construct in that most people don't face the same curve. So in reality, not everyone will actually see the same thing. Does that make sense? Yeah. So the theory says that it's all based on the market. The reality is we don't all see the same curve, so it doesn't actually apply to everyone in the same way. All right, so then this red line is a capital market line. We took the risk-free rate, sent it in a line tangent to the efficient frontier, and what we have here is the market portfolio. This is a portfolio of all assets that exist in the market in the proportion that they exist in the market. So modern portfolio theory says that all investors should hold a combination of two things. What are they? And the market. That's right. So that's why we call it two-fund separation. We should all fully diversify by holding the market portfolio, and then it's just a case of how much do we put in risk-free and how much we put in the market. The answer to that question depends on the indifference curves. And you've got two here, one in green, one in red. Of these two, which would be the more risk-averse investor? The green. The green, that's right. Because the green is more risk-averse, it's got a lower risk, they're willing to take a lower return but to lower their risk. The red is a more they're still risk-averse, but they are a less risk-averse investor because they're willing to take on more risk to get that uplift in return. The investor with a utility curve like the one in green is going to split their wealth between the risk-free asset and the market. In other words, they will lend some money and they will invest in the market with the rest. Is the investor that has the utility curve in red a lender? They are instead a borrower, right? They're going to borrow money. They're going to put all their own money in the market. They're going to borrow some more money, put that in the market portfolio as well, shifting it up the capital market line. But that's the only way that investors differ, where that indifference curve sits along the capital market line. So it's a really pretty theory. It gives us some really enduring messages that I'll come back to. But there's a bunch of assumptions that undersit this graph. First of all, it assumes a single period model. Which period it doesn't say. And I'll go through all of these in the next slide in more detail. But the fact is, a lot of investors don't just care about returns over one period. They care about returns over multiple periods, right? We have review periods as well as holding periods. And there's only one period in this model, but the fact is different investors have different holding periods as well. The second thing is it assumes that the only two things that matter are mean and variance. Now, if all assets had a normal distribution, maybe that's a fair call, but that's not the case. Even equities don't follow a normal distribution. Things like options definitely don't. There's skewness and kurtosis as well. If investors had quadratic utility functions, then all they would care about is mean and variance. But again, we know that's not true. They care about downside risk. They care about the probability of loss. So that assumption is going to be violated. It assumes that investors differ only in their level of risk aversion. We've seen again and again that that's not the case, right? They're going to differ in their need for liquidity, in their investment horizon. They're going to differ not just in how risk averse they are, but in their key risks, right? Remember last week, if you're in a defined contribution fund, you have a greater exposure to market risk than if you're in a defined benefit fund. It assumes that markets are frictionless and efficient. Everything is priced at their fair value. There's no transaction costs. There's no taxes. People can borrow and lend at the same rate as each other, and they can borrow at the same rate at which they can lend. I'd love to be in that world with my mortgage, but I'm not. There's no way, right? We know that retail investors pay higher brokerage fees than institutions. So that breaks down as well. And you need all of these assumptions to get to that bottom one, which is that two-fund separation holds. When you violate the assumption, you violate two-fund separation theorem. Because the fact is, different people in this room will face different curves, which means it's not possible for everyone to access the same market portfolio. Think about it as simple as hedge funds. Hedge funds should be included in a multi-asset class portfolio. They should be sitting on the efficient frontier. But if you are not a high net worth investor, you can't invest in hedge funds. So you don't have the same market portfolio because you can't access some of the assets on it. So there's a whole lot of problems that are going to break down this theory. And I want this slide goes through them in a bit more detail because we're going to, from understanding what the issues are, we can start to find solutions. So remember, we said that the investment horizon is undefined, but it matters. And it particularly matters if returns are not what we call IID or identically and independently distributed. If returns are IID, it means they follow a random walk. Can anyone tell me what that means? Or what the implication of it is in terms of predicting the next period's return? Sorry, say. Yeah. Doesn't affect the future? Yeah. So, yeah, exactly. Okay, so if returns follow a random walk, you can't look at past returns and trends to get an idea of what's going to happen in the future. The best chance you have of predicting the next period is where you're standing right now, because anything could happen. So because of that, a random walk is often called a drunkard's walk, right? Imagine that a guy has been sitting in the bar drinking for the past 8 hours, and then he picks up his dog, which is also going to be running in every direction, and tries to stumble home. He may have a general trend, he may have some idea of where he's going, but if he has come to a standstill, and his dog's about to go in one direction and he's about to go in another, you don't know if he's going to go forward, backwards, sideways, or fall flat on his face, right? The next step is impossible to predict. If that is the case in markets, then it wouldn't matter whether you split your period into months or quarters or years or 5 years. The distribution of returns would always look the same. And if that was the case, we can say it doesn't matter that you don't define the investment horizon. Because it doesn't matter if you guys have a 3-year holding period and I have a 20-year holding period. Or if you guys care about monthly returns and I care about quarterly returns. That doesn't matter because the distribution of returns would be the same irrespective of how you slice up a period. But the reality is returns don't tend to follow an IID path. We saw last week, we have serial correlation in returns, right? We have momentum over the short term. We have mean reversion over, so momentum 3 to 12 months. Mean reversion over 3 to 5 years. They are trends that can help you to predict patterns. We see that we tend to have 10-year business cycles, although there was only 6 between the dot-com crash and the GFC. And what we're going to see in a couple of weeks is if you look at something like interest rates, there has been a huge and clear downward trend. Although US is starting to muddy that a bit, there's been big changes recently. But if you go back a year and then look over the previous 10, interest rates are just going down, 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 down. When you have something on a predictable path, you break down the assumption of IID returns. And then the investment horizon matters, which violates the condition of modern portfolio theory. The next is that it's a single period model, but in reality, the world is multi-period and investment opportunities change each period, right? There are asset classes available now that didn't exist 20 years ago, didn't exist 15 years ago. We see that the causes of volatility have changed through time, and we've seen that investors change through time. So to assume a single period model is not going to work for the majority of asset allocation situations. The third is it assumes that the only way investors differ is in their risk aversion. We've already seen that's not going to be the case. They're going to differ in their objectives. Some will be liability-driven investors, others will be asset-driven investors. Some will care about absolute returns, some will care about relative returns. Some will care about the next 20 years, some will care about the next 3 weeks. Some will be able to access hedge funds, others won't. Some will be facing high marginal tax brackets, others won't. I'm going to show you 2 things, one to do with tax and one to do with cost. If I start with tax, and I'm taking a bit of a punt here, I think we're doing this in week 6, let's see. What we see in week 6, I hope, yes, excellent. What we're going to do in week 6 is we're going to see how the exact same investment can have a completely different return depending on your tax situation. And in this case, we have a super fund and a private investor. Don't worry about the details, we'll go through it in week 6. What I want to show you is the exact same investment, which therefore has the exact same risk, has a completely different after-tax return. The retail investor, which is in the top marginal tax bracket, has a 7.6% after-tax return. The super fund has a 10.2% after-tax return because of franking credits and preferential tax treatments. Right? How do those, that's one asset, 2 investors. It can't sit on the same modern portfolio theory efficient frontier. Right? Because it's the same asset, but the returns are completely different. 2 different points if you were going to graph it. So the fact that investors differ in their taxes mean they're going to have different efficient frontiers. And the other one is the transaction costs. Now, I've had a couple of questions about this, so I actually wanted to show you guys a direct example. A couple of people have come to ask me why it is I say, why it is I say that if you're a big investor with a lot of assets under management, you have a risk of price impact in that you might shift up the price. And people have also said, why is that a bad thing? Because you want the price to go up. Remember, if you think an asset is undervalued, you want to buy it while the price is low, and then the market will realize its mistake, the price will go up, and you will sell it at the high price. But you don't want to be the one that pushes the price up yourself. Because if you push the price up, you're not buying low. You're buying at the price you've pushed it up to, right? So to show you this, and I think this is going to work, I tested it before. This is my ComSec account, not my actual trades. This is the order book of the ComSec account. And I want to show you guys what I mean when I talk about price impact. And I'm going to show you 2 stocks. One is Telstra, the other is A2 Milk. Let's say that you think both of these are undervalued and you want to therefore purchase 100,000 shares in Telstra and 100,000 shares in A2 Milk. I've never tried this before today. This is great. Can people see that? Wait. Is that clear enough for people? And I'll just move it up a bit as well. Wow, my screen's really dirty. Okay, so if you have a look at the sellers. These are the people that are willing to sell you Telstra shares. You want to buy 100,000 shares. So you're going to cross the order book. You're going to take up one of these sell orders to purchase the shares. You can see you can buy 400,000 shares at a price of 2.82. There's no price impact for your trade. There's the price. You will buy it. You will not change the price as you go up the order book. So that does not have a price impact here. Yes, you're going to have to, like, if your bid is 2.81, yes, you're going to need to cross the bid-ask spread. But you are able to trade without impact. Now let me show you A2 Milk. You want to buy 100,000 shares of A2 Milk. Have a look. First of all, if you want to pay 9.61, you can only buy 2,221 shares. You've got to buy 100,000. Have a look how far down the order book you're going to need to go before you can complete that purchase. See how the price is going up and up and up as you do it. This is price impact, right? If you need to buy a large amount of shares and there isn't enough supply at the current price, you're going to need to be pushing the price up. You're going to need to be taking, a higher price each time. Right? that is price impact. Does that make sense? So see how you're not buying at that low existing quoted market price anymore. You're pushing the price up. The bigger the fund gets, right? Even go back to Telstra, imagine that you want to buy 500,000 shares. You're going to shift the price. You want to buy 1 million shares, you're going to shift the price. Okay, so that's why I say as more and more funds under management occur, you're going to need to put more and more money into an investment, and in doing so, it may have been underpriced at the start, but it might not be by the end of your trade. Which is why there's a lot of strategies about rolling out an order, because you buy some and then you hope that more sellers come in, so more liquidity comes in, so you don't need to have as big a price impact compared to if you trade everything at once. Okay, so different investors will face different costs because some might be bigger than others and therefore might have more risk of price impact. Different investors will face different costs because retail investors have typically higher fund management fees than institutions, higher brokerage fees than institutions. Endowments might not pay tax, right? So there's all these different things that mean there's no way that every investor will have the same picture. And if they don't all see that same picture, it can't be that two fund separation exists. Because no one, I mean, you can't all hold the market portfolio as one portfolio if it's different for every person. And the last issue is that it would require you to run an optimizer across all available assets that exist in the economy. Now that's fine for equities, fine for fixed income, right? They're relatively liquid, they have a long price series. Bit more of a problem for things like hedge funds because you've got selection bias. That means you're upwardly biasing your estimate of expected returns unless you account for it. Bit of a problem for direct property because it's appraisal-based valuations, so it's going to smooth out your returns and understate your risk. Massive problem for infrastructure because you don't have the data. Every time you have issues with the data, you need to make more estimation in terms of what you think the expected return, variance and covariance is. Every time you are less confident in your estimation, you have a risk of making a mistake that rises. And what we're going to see soon is that optimizers are error maximizers. You make one mistake and it's going to jump on it. And I'll show you why soon. Right? But that's a curse of dimensionality. The scope for making a mistake blows out exponentially as you increase the asset classes and the data condition gets worse. So at this point, I basically spent, a couple of slides bagging a lot of what you guys learned in investments. So you might be thinking, why on earth do we come here and learn all of this stuff? And the fact is that modern portfolio theory is far from useless. It's actually priceless in the messages that it gave us. Just because we can't apply it to the letter doesn't mean we can't apply it. Because before Markowitz, we didn't know what is such ingrained understanding now. You learned these messages in Foundations of Finance. Why do you need to diversify? What does diversification do? Yeah, improves your risk-return trade-off. It reduces your risk per unit of expected return. When you diversify, you need to look at correlation. What is the ideal scenario in terms of the correlation of two assets? -1. What is the only correlation under which diversification won't work at all? 1. Right? As long as the correlation between asset classes isn't 1, you can diversify. But of course, if you have to pick only a few asset classes, you want to be getting those negative correlations in. So correlation matters. And why, first of all, when we say risk should be defined in a portfolio context, what are we saying? Look at portfolio risk, don't look at what? What's the alternative to seeing it as a total portfolio? If I care about the risk of Fortescue as a stock, do I care about the risk of Fortescue or do I care about the risk of Fortescue in my portfolio? In the portfolio, right? Because think about the CAPM. What is the measure of risk in the CAPM? Beta, systematic risk. It's a covariance of Fortescue with the market portfolio, scaled by the variance. So what we're saying, all of this comes out of modern portfolio theory and is then also made official through the CAPM that came afterwards. You need to diversify so that you're not wiped out when, say, Lehman Brothers takes a dive and all your money is in Lehman. when you're going to diversify, you want to look at the correlation. Don't sit there going, I've diversified because I bought shares in Pepsi and Coke, right? Because they're the same asset, basically. And when you look at the risk, don't look at the risk to the one asset. Look at the risk in terms of how it contributes to your total portfolio. Because you might have an investment that is as risky as anything on its own. But if it has a negative correlation with your portfolio, if it has a negative beta, it would actually reduce your portfolio risk as a whole. Okay, so you should care about total portfolio risk by looking at correlations, by looking at betas, and you should be diversifying. Really important messages that you can use even if you're not using traditional modern portfolio theory to the letter. So the next thing I want to do is say, all right, well, let's take those enduring messages and start to bring them into reality. And I want to start by giving you guys an overview of how portfolios are built in practice and how the industry will move over time. And I want to give you some examples of industry portfolios. And then after the break, we're going to look at some actual methods of applying this. So the first thing to realize is that there's a huge influence of industry norms. And what I mean by that is if you look at the, yes, question? Yeah.
So the systematic risk for them is the same, and we find that diversify the systematic risk
Yeah.
for the market. So if we invest in both in Pepsi and Coke, and imagine something happens to Pepsi, and the shares Coke rises because of Pepsi, isn't that diversification?
It is, and it can. And when I say don't do it, they're not perfectly positively correlated. So as you say, look, it is true. Because they don't have a perfect positive correlation, there will be times when one of them is suffering more than the other. So, you know, it is, but at the same time, their correlations they're above 0.9, right? So it's possible, but it's rare. Typically when Pepsi is doing poorly, Coke's doing poorly. When Pepsi's doing well, Coke's doing well. But if there is a firm-specific event, like you say, then there is a benefit to having both. And that's why I say as long as the correlation isn't +1, there is a benefit. But under that argument, I agree, there are times where you're going to be glad you had them both, but there are a lot more times where you'd be happy that you bought Combank and Coke, right? But you're right. Look, as long as correlation isn't +1 and you have the scope to diversify, you keep spreading that wealth, because sometimes there will be a firm-specific crash to one company that will leave the other one relatively immune, or they may even end up better off, right? Like when Ansett crashed, Qantas benefited, so it can happen. So there's a big influence of industry norms. Superannuation portfolios in the industry tend to be pretty similar because historically they've been built along similar lines and the industry moves slowly. There are some differences, and I'll go through those in the next slide. But the fact is, because they've been all able to invest in similar asset classes, and traditionally that wasn't very varied, because they've all used similar asset allocation methods, they all end up with roughly similar allocations. For example, until the last couple of decades, there hasn't been a lot of alternative assets, and equities have been easily the easiest asset to trade. And people have been trying to get big long-term returns, so they've been very popular in super. So they tend to dominate superannuation fund portfolios for the most part. There has been a bit of change, particularly post-GFC. Funds are starting to de-risk, but equity is still a very dominant part of the portfolio. The next thing is that you tend to come into a legacy portfolio as a starting point, and then you make changes slowly at the margin, right? So remember, if you come in and take over a portfolio, what you're taking over is what we call the legacy portfolio. And we said last week, you're not just going to sell it and start anew, because what would you incur? Transaction costs, right? And you don't want to end up selling an investment in an Australian equity ETF only to purchase it again in a different weight. That's a huge waste of money. So instead, you're going to say, this is what I have, this is ultimately what I want, and I'm going to slowly work my way towards that while keeping my transaction costs at bay, while keeping my peer risk constrained to whatever my mandate requires. So you tend to make changes at the margin. And because industry portfolios have traditionally been very similar, What you see as a result is that the industry doesn't leap, it drifts slowly towards more optimal allocations. Now, to illustrate that, some of you will have seen, and some of you will soon see, the solution to the first question of the tutorial in weeks 2 and 3, depending on the group. This is the key trends in the funds management industry. Every year, I update the papers to the most current year in terms of reporting on these key trends that emerge. So every year, the documents you guys are using to analyse the key trends are changed and updated. But to give you an idea of how slowly the industry moves, I wanted to show you, my wattle only goes back to 2016, but this is the solution in 2016. There's a lot of similarities between the solution here and the solution today. There are some changes, but not all that many. The industry is still on its drift path, right? The industry is recognising that active returns on average are not particularly strong, particularly in developed and transparent markets like the US. So passive investing, which is lower cost, and active investing isn't really outperforming passive on average, passive investing is becoming more popular. It was becoming more popular 3 years ago, more popular 5 years ago. It's still becoming more popular today. There is a slow drift towards alternative asset classes. There is a slow de-risking, right? So all of these things, there's some, like increased regulation and governance, that's new. That's a particularly hot topic in the last year or so. But the long-term trends are happening slowly. So you can't sit there and say, well, we know that there's a home bias, why isn't it fixed instantly? Because the industry doesn't move that way. The next thing is that the way that asset allocation happens in practice tends to be what we call a tiered approach. If you think about modern portfolio theory, all you're doing is taking all of the asset classes that exist, figuring out their value weights, and figuring out your market portfolio. It's a bottom-up approach. What tends to happen in industry is that if you're a superannuation fund, you're going to have a bucket of money. Oh, by the way, another thing, oh, that's right, I've got them zoomed in. Another question I've got, a superannuation fund is a pension fund. We tend to call it super in Australia, tends to be called pension in the UK, but we're referring to the same thing. So you've got a bunch of money in your super fund. If you're going to decide how to invest this money, the first thing that you tend to do is what we're starting to do today. You tend to split that money between the different asset classes. Some money you'll put in equity, some in fixed income. Sometimes people will split cash off as a separate asset class, not all, but some. And then you'll have, say, an alternatives bucket. That will be split into private equity, hedge funds, direct property, infrastructure, and commodities, and so on. The list is endless. Equity, you will have Australian equity, you'll have world equity. Your world equities, some will be hedged, some will be unhedged. We'll look at all of these as the semester goes on. Within your Australian equity, you might put some with a value manager, some with a growth manager. Then your value manager will go and invest in stocks, right, Telstra, for example. Your growth manager will go and invest in stocks, maybe A2 Milk, if we go with what I gave today. Sorry. So as you can see, this isn't a bottom-up approach. You start with money, you allocate that money across asset classes, you split that money further into different strategies, you then split it into different managers, and only then do the managers go and invest in the end assets. When you have a system like this, you will move away from the traditional market portfolio of modern portfolio theory. To give you an idea as to why this is, let's think about a fund like UniSuper. A lot of big funds like UniSuper tend to have an in-house investment team for some of their fund, and they tend to outsource the rest. One of the first things that tends to be moved in-house is Australian equities. So let's say you're a big fund, you've got an in-house Australian equity team to manage your Australian stocks, and then you outsource the rest of your asset allocation to other managers. That means that you've hired a bunch of people within the fund to invest in Australian equities. If you've gone to the trouble to do that, are you really going to give them 5% of the equity weight of the total amount in your portfolio, which might end up being 1% of the total portfolio? There's no way, right? You're going to give them enough assets to make it worthwhile to have an in-house equity team. We're going to come back to that in a couple of weeks, but because of this, what we call fill the buckets approach, you're not going to end up with a portfolio that has market capitalization weights. I think I just said it then. This is actually what we call fill the buckets approach. It's quite popular in the industry. We do that in week 5. The next thing is that there is a widespread pursuit of active returns. That's what we call alpha. Alpha is the holy grail of investing. It's beating the market on a risk-adjusted basis, and it's what every active manager is aiming to do. It's very, very popular because, let's face it, you can charge more fees by saying that you're active, because you're promising investors, or at least you're saying that you will aim to deliver them returns that are better than if they're in a cheaper passive market fund. Trouble is, what we've seen, particularly in markets like equities, particularly in the US, the UK, in Australia as well, although Australian small cap active funds are still doing well. But in general, on average, in developed markets, active equity managers are not outperforming passive alternatives. So we are also getting an increased popularity of passive investing. So active investors are losing ground a bit, but you'll still hear active again and again and again out in the industry. Everyone promises that they're better than the next guy, that they're better than the market, even if it's not the case. Another big one is that you do have a constraint of asset availability. You can only invest in the assets that you can actually access. Right, so we said before with hedge funds, if you are not a high net worth investor or institution, you can't invest in a hedge fund. You are not legally allowed to do it. You might want to take a huge direct property weight, but there isn't all that many property deals to go around, particularly for a retail investor. You might want to put your money in a private equity fund, but private equity funds tend to favour their existing clients or big names that they can use to market the fund, right? Think about it. If you're a private equity general partner, you want to take on a small handful of investors. You want each of those investors, those limited partners, to give you a lot of money. You want those investors to be big names, so you can say, guess what? Trust me, guys, you want to give me money because, George Soros has given me money. Or you want them to be existing clients because you know that they will give you the money when they promise, you have a good relationship with them, and it's easy. Right? It's really hard as a small mum and dad investor to go and give money to a private equity fund. They're often not even marketed in that way. So particularly for alternative assets, asset availability is a big constraint, and it's another thing that you guys will talk about in your assignment. Because you're going to recommend an asset allocation, that allocation needs to be feasible for your investor. Real-world influences matter. I've already spoken about a lot of these, like liquidity, fees and cost. Resources, you can only invest so much that you have the money to do so, right? There might be a great new investment opportunity, but if all of your money is already locked up in illiquid asset classes and you're not willing to take that haircut, you may not be able to sell something that will enable you to fund that new opportunity. Business risk, we spoke about. One example is things like peer risk, right? So you might want to correct the home bias, but if you do so, you might take on a massive tracking error risk, and that may actually violate your mandate. You might, in your investment mandate, have a requirement that your tracking error is no more than 2%. And I'll give you a tracking error requirement in the assignment as well. Decision-making structures is another. A really good example of this is a student-managed fund. So the student-managed fund has two different investment arms, asset allocation and active Australian equities. Investment is done with a view to the long term, to support long-term scholarships and prizes. Think about the active Australian equity team. They have come in and immediately are met with a culture, we are investing for the long term. So luckily this isn't and hasn't been an issue. But if you think, let me tell you how an investment can happen. If we stick with the active equities team, they're going to analyse, they're first going to put in a stock filter, that's going to give them potential candidate stocks. They're then going to go into in-depth analysis on some candidate stocks. Some of those will lead to a potential recommendation. They'll put forward the proposal to the group. If the group votes and confirms, yes, we are happy for this recommendation to go forward, then the team takes it to an investment advisory committee meeting. The IAC Investment Advisory Committee is made up of industry experts. Some are based in Canberra, a lot are based in Sydney, and some Melbourne. So they can't come and meet whenever they like, right? We have 3 IAC meetings a semester. So that means that you will they'll come up with recommendations, and they can only put those forward 3 times in that semester. Now that's fine because they invest for the long term. But let's say you came in and you wanted to do some quick market timing turnover strategies. You want to buy something now, sell it in a couple of weeks. Your decision-making structure will not let you do it because we can only meet with the IAC 3 times a semester. So it's all very well to want to make an investment, but if your decision-making structure won't allow it, you can't follow through on the strategy. Now, for the fund, that's a good thing because we're not encouraging short-term turnover, we're encouraging long-term investing. But if you want to take an investment strategy that your governance board doesn't agree with, you won't be able to go ahead. And the last, and it's a broken record, I'm going to keep coming back to it, and that is that you should use the numbers to help you make a decision, but not to make the decision for you. This little guy here will not make a decision as well as a human brain will. You can use it, but you need the overlay of common sense as well. Any questions on any of that? Okay, so to have a look at what the portfolios in industry are actually, how they're actually constructed, I've got 2 different graphs to show you. This is a little outdated. It's back in December 2008. I would love them to update this. They haven't, so which is why I'm going to show you the graph after this to give you a more up-to-date picture. But this was a really, really great study because what it did is it took the Australian institutional DC funds. So these are institutional funds, the aggregators. They are in the business of investing. They split the asset allocation up: conservative, balanced, growth, and high growth, right? Remember, conservative is your lowest risk return policy. High growth is your highest risk return policy. And they showed the asset allocation of the different policies. If you have a look at this, how does high growth dial up the risk and return? What's the key difference compared to conservative, or if you go up the scale? What's happening? Equity weight is increasing. Look at your growth assets. Conservative has only 23% equities, through to high growth, 77%. 3/4 of the asset allocation is in equities in a high growth strategy. How are they dialing down the risk? When they're dialing up the risk by buying equities, what are they selling? What are they having lower weights in? Fixed income, right? You see, to get the high risk, you're going up in equities. You're enabling yourself to do that by having less fixed income. You've got, well, specifically actually it's fixed income and cash, right? Conservative funds, 37% fixed income and 24% cash. Well, if you go down to high growth, there's only 4% fixed income and 1% cash. So you can see big equity weights and low fixed income and cash rates as you go up towards high growth. The alternative weight doesn't change that much. Remember, we said alternatives is a new asset class, the industry moves slowly, and they're difficult to access. So you can't just dial up your weight in alternatives, there's not that much to go around. The other thing that's interesting is, remember, we said there was a home bias. These are institutional funds, and yet the home bias is huge, right? Conservative is the worst. 36% only of the fund is in international investments. High growth, it's a bit better. It's about 50-50 international and overseas. But that's still a major home bias. Now, this was back in 2008. To convince you guys that this picture would still be very similar today, what I've got here is another study that showed you the change from 2009 to 2015. Now, these are not just institutional DC funds, these are all Australian funds, so you've got retail investors there as well. But if you have a look at what's happening, start in the middle, back in 2009, you can see similar trends. You've got a large, this is overall, right? We're not talking about conservative to high growth, this is everyone combined. You've got a large equity weight, a big home bias within that, right? Australian equities are more than international equities by quite a long way in the inner circle. You've only got a small amount of alternatives, bit of property and infrastructure, so the alternatives are alternative assets excluding those, and a nice big fixed interest weight as well. Go to the outer circle and not much is changing. You do see, the two things that you do see is a slight reduction in the home bias within equities and an expansion in your alternatives. But they are small changes, right? So you can see how slowly the industry is moving here. Okay, so my words are getting jumbled. You guys are probably getting spaced out. Let's take a 5-minute break, and then we'll finish off with 2 different ways to use mean variance optimization. So let's come back at 3:35.
So the static is why we fixed the Apple 30% equity and 70% debt throughout the time.
That's right. So, and it means you don't change it. You might review it. So 5 years from now, you might say, oh, maybe I was wrong, then I might change it a bit. But you always do it for the long-term view, and you're not changing your weights through time.
But I think it's kind of like, it's realistic. Maybe it's not like ultimately by return.
Yeah, that's true. And that's why dynamic became so popular, because the idea was that ultimately you can do better by focusing on the fact that, you know, you change, investments change, you can actually get a better risk-return trade-off by doing that. Because if you were going to invest, you know, for the next 20 years and not allow your asset allocator to change, you'd probably be too low risk now because you wouldn't be able to change it in the future. Anyways.
The difference between a value manager and a growth manager?
So a value manager is trying to find stocks that are undervalued, essentially because they're out of favour with the market, right? So these stocks would have potentially, they'd be well established, they might have a strong balance sheet, but the price would be quite low, the market price.
So are they active?
A value manager, they're typically active. You have, in America, you have some passive value funds because you have passive value indices. In Australia, you don't have value versus growth indices in the same way. So typically, if you are a value manager, you are active. You are actively trying to find the best performing value stocks. And a growth manager is an active manager trying to find the best performing growth stocks. But you're looking for different attributes. Right, so in the same way that you might be an active manager in large caps or an active manager in small caps, right? It defines the universe of stocks that you look at. Does that make sense?
Yeah. And for that example on the class for the Coca-Cola and the Pepsi.
Yeah.
So it's like the student asking for, because the firm have a firm risk,
Yeah.
so it's one firm for that, so the other one gonna have a high return.
May have, right? May. So, and I don't know it's interesting what would happen with it. I can see that happening with something like Coke and Pepsi, but think about, so Qantas and Ansett, this might be showing my age, but Australia used to have 2 massive airlines. One was Qantas, one was Ansett. When Ansett went under, all of that business went to Qantas, right? So that was the example that happened. So if something, and it's rare, but if something happened where 2 products are in competition and your competitor goes bust, it might be that when your competitor goes bust, that business goes to you.
Okay.
And that would give you a boost.
So this is really small probability, and it's not like kind of structure for investor.
They don't have, it doesn't happen often, but the fact is you should be, so there's a small chance that would happen. It's a bigger chance if you're in 2 unrelated industries, right?
Okay.
So the general policy is diversification is good. Yes. Yeah, that's right.
and for the home buyers. So the theoretical correct proportion of domestic investment is really what works.
Well, we're going to look at it in week 6, but it's about 3 to 5%, depending on what you want to define the universe as, but it's really small.
Understand why the decent cost rates like cash are flexible.
Yeah.
But some of them are still considered 24%. What's the benefit of holding that?
So it's interesting. So in the super review that's going on at the moment, one of the things they found is that they're way more conservative than they probably should be.
Is it invested or is it literally just
No, if it's invested in cash, it is invested, but it's invested at the cash rate, which is pathetic at the moment. So there's been times in the past where the cash rate's been really good. So it's not that cash as a concept shouldn't be there, but at the moment they're so low that it really doesn't seem justifiable. And there's a tendency to think, oh, cash, it's safe, but in the long term it actually isn't, right? So the balances are too high.
That's it?
Yeah. It might be in their models, it might be in their forecasts, but it certainly seems like they're claiming to use it as a de-risk, but they're using it earlier than they should, right? They're de-risking before the investor really would need them to de-risk. Anyways. All right, hi everyone. So where I want to finish up today is by looking at 2 different ways to apply modern portfolio theory. The first is to take mean variance optimization directly and to use it through Excel, through something that we call Solver. The second is to use the principles behind it as the basis for a portfolio analysis workhorse. So I want to take you through the 2 different examples. I'll just give you an overview here and then we'll go into a bit more depth. But let me start with the first, which is using mean variance optimization. And to do this, I've got up video number 2. By the way, thank you everyone that voted for when you want these videos released. So far, it looks like the winner is to release it when I release the lecture notes. So, for example, next week's lecture will be released tomorrow, and I'll release the videos at the same time. I've let you guys poll until the end of tomorrow, but it looks like that's going to be what happens, and so that's what I'll change it to do. Now, what did I want to show you here? The optimizer. All right, so this is what you're learning to do in this week's Excel videos. You're sketching out modern portfolio frontiers. I don't know, modern portfolio theory. You're sketching out efficient portfolio frontiers. So essentially, you're doing this through a little technique called Solver. And what you say to Solver is you say, all right, Solver, here are my asset class returns. And from that, here are their returns and their variances, so their expected return and risk. And you say, Solver, I want you to give me the efficient frontier as follows. The first thing you do is say, Solver, forget about return. Tell me the weights that will minimize my risk. In other words, tell me what the minimum variance portfolio is. And Solver, and the video shows you how to do it, will think and think and think, and it will come up with a set of weights that gives you this bottom point to the left, and that is your minimum variance portfolio. That is your starting point. You then say, thank you for that, Solver. What if I want a return that is, say, here, 0.5% above the return on the minimum variance portfolio? So I want a little bit more return. Now tell me the new set of weights that will minimize my risk given that return. And Solver will think and think and think and come up with a new set of weights. And that will give you the second dot point. You do it again and again, each time adjusting your return requirement upwards. So then you say, all right, Solver, now I want 0.1% return higher than the minimum variance return. What set of weights minimize my risk? And through that process, you sketch out something that looks like an efficient frontier. Then you go back and you say, all right, let's go back to modern portfolio theory. Yeah, that looks, about right, pretty good. Look at what Solvers have managed to do. I'm done, right? Is anyone going to be done at this point? You haven't done it yet, so you don't know the answer, but probably you can guess that the answer is no. This is what Solver will give you, and it looks great on a chart. But I like to think of Solver as that little puppy dog that wants to please you so much, but has no idea how to do it, right? You get home, you're exhausted, and your dog runs up to you, and he's been in the garden, and he traces dirt all the way through the house, and he jumps on you, and he gets your clothes dirty, and then his tail's wagging, and he knocks off a bunch of china, and he causes devastation. He wants to do the right thing, but he's not quite managing to do it because he doesn't quite get what it is you want at that point in time, right? So if anyone has a dog or has had a dog, I had a dog, and he was my best friend. He was like the best thing in the world. I love him so much. But I wouldn't want him to set my asset allocation. And that's what Solver's doing, right? Solver is setting your asset allocation with no common sense underlying it. Because Solver does what we call error maximizing. Let me show you some of the numbers that come into this very pretty looking curve. In fact, let me do it on the PowerPoint. Oh, wrong one. So if I go to here, have a look at this first set of asset class weights. It's not as crazy as the second, but this is actually the portfolio that maximizes the Sharpe ratio in the example I just showed you. We've got negative weights. We're shorting listed property, we're shorting commodities, and we're shorting Australian fixed income. A whole asset class we're going short. Very difficult to do, particularly if you can't trade in derivatives, which a lot of funds can't. Problematic. Now have a look at this bottom allocation. This is what came out of you telling Solver to give you a portfolio that minimizes your risk with a return 0.35% above the minimum variance portfolio. Negative 185% of your weight went into Australian fixed income. 252% of your weight went into world fixed income. Is that a feasible allocation? Right? Can you imagine going to your investor and saying, I've got your asset allocation, we're good, we're good. We're going to short negative 180% Australian fixed income, and we're going to put everything and more into world fixed income. They're going to go, what on earth are you telling me to do? It can't happen, right? Solver, that little puppy dog, did everything it could to give you the numbers you asked for, but it doesn't have common sense. That's what we call error maximization. What happens is, if you have a slight imbalance between the risk and return of different asset classes, so if you make an error by overestimating the return per unit of risk on one asset class, just one, Solver will run to it. It will maximize the error in your portfolio by taking as high a weight as possible in that asset where you gave too high a return per unit of risk. And it will short the other asset classes to get you there. So if we go back and look at the returns of world fixed income and Australian fixed income, you can see exactly why Solver gave you those weights. Australian fixed income for that historical period happened to have an average return of 8.55% per annum and a volatility of 4.36% per annum. World fixed income had a higher return and a lower risk. But remember, return is what eventuates despite the risk, and they don't always align after the fact. That's the nature of risk, right? Just because historically Australian fixed income over this one period happened to have a lower return than world fixed income despite a higher volatility doesn't mean that's rational, doesn't mean that's going to happen next period. But Solver doesn't know that. It's just going to run to want to give you the best outcome by going long 280% in world fixed income, short 180% Australian fixed income. So it will maximize the error in your portfolio. So if you're going to use mean variance optimization, you need techniques that are going to calm it down. And we'll go through that in the next slide. It's also arguably not rich enough given the complexity of your decisions. And that's everything that we went through in this previous table here, right? It can't look at things like differences in investor opportunities. It's difficult to incorporate different tax rates, for example. So what you might want to do instead is you might want to use the principles underlying mean variance analysis to form the basis of a portfolio analysis workhorse. If you do that, you're going to generate basic measures of portfolio risk and return, and you're going to say, all right, well, here's my starting point. If I tweak the asset allocation manually, do my portfolio risk and return measures get better or worse? So if you go, this is Excel video 1, right? Here are your weights of your investor's portfolio. Because of these weights, they end up with these outcomes here. So if I instead had 7% in Australian equities and 63% in world equities, does my return go up or down? What happens to my probability of loss? What happens to my tracking error? And if the outcome is an improvement, you stick with the new weight and then you try to make another marginal change. If the outcome was worse than how you started, you go back to how you started and you take a different tweak again. It's a much slower method than mean variance optimization where you just press a button, but it means that every tweak is done with that underlay of intuition and common sense. So it does mean that every change has a reason behind it, which means that you're bringing the layer of common sense in right through the analysis. It is a longer method, so there is often a preference for mean variance optimization, but if you do use mean variance optimization, you're going to need to have the overlay of common sense come in after the optimizers at work. You can use it as a basis for simulations. All that means is you can link it into a bootstrap, like in video 1, right? Tweak these weights. That will affect the outcome in the bootstrap, which will affect the result from your bootstrap simulation. And you're going to do all of this. You might choose to do it in the assignment. I'll show you how to do it in assignment tutorials. Sorry, in assignment workshops. Now let's say you decide to use mean variance optimization in practice. There's a couple of techniques you might have to try to calm that optimizer down. Right, so the first is that you might impose weighting constraints, and you're going to do that in Excel video 2. Remember, we had these ridiculous outcomes where you were long 252% world fixed income, short 180% Australian fixed income. So the first constraint you might want to impose is, I don't want any of my weights to be negative. That's what you do in the next exercise. And as you can see, when you run Solver in your long-only exercise, we have no negative weights. But what's the problem here with error maximization? I mean, Solver hasn't given you a negative weight, but it's still done everything it can to do what you've asked within the constraints you've imposed. So it's maximized the error up to the constraint that you've made. In other words, to get that higher return in this case, it's just gone 100% equities. It's not a rational portfolio, but the computer doesn't know that. The computer only works with what you've told it to do. Another example is you might want to limit the weight in direct property, and that's what you're going to do here. The returns are different because you've adjusted the returns. But you say, all right, Solver, minimize my risk per specific amount of return, given the fact that I don't want you to short any asset classes and you have no more than 10% of the portfolio in direct property. Solver will do that, and guess what it comes out with? 10% in direct property every time, right? It's still done the best it can for you given the constraints you've set. So it maximizes the error in your portfolio as much as it can within the bounds you've set. So having weighting constraints is good, it's useful, but it is limited in that it's only going to be as good as the constraints that you impose. A better method, and you often have both of these at work at once, is to constrain risk relative to a benchmark by constraining your tracking error. So what you say is, you say, all right, Solver, I want you to constrain, I want you to give me the lowest risk for a given unit of return, subject to not having any negative weights, no more than 10% in direct property, and subject to having a tracking error of no more than, say, 2.5%. When you do that, you're going to get a much more respectable looking portfolio because you're tethering it to, say, a peer group that has a respectable allocation already. Solver can't move too far away from the peer group which means it's going to have a good spread across the different asset classes. Because you've allowed it a tracking error of 2.5%, it's still going to try to do better than the peer group, but it is going to have a spread that is reasonable. So it's in the same way that if you're in an antique fair, you're going to ideally tie your little puppy dog up so it doesn't have too far to run, right? It's the same thing with Solver. You're tying it to a set of diversified asset classes, and it's going to try to do the best it can within that, but you'll still have the diversification implicit. When you combine that with things like a maximum weight in direct property, and by the way, why would we impose a maximum direct property weight when Solver's an error maximizer? Why might Solver want a lot of direct property? We looked at this last week. Underestimated risk because of appraisal valuations, that's right. Right, so you're now constraining it to something a bit more realistic. You might use the approach of Black Litterman. Now, Black Litterman is a way of getting essentially, you're going to get baseline expected returns and then override them if you disagree with them. But it's a way of ensuring that your return for your asset class is in line with the risk. Because remember, with error maximization, the problem comes when one asset class has really a too good risk-return trade-off. Because if the risk-return trade-off, if the return per unit of risk is too high, Solver will want everything in that asset class. So what you do with Black Litterman is really similar to the CAPM in its first step. The CAPM is the expected return on an asset, is the risk-free rate, whoops, that's an equals, plus the beta of that asset with the market times the market risk premium. The first stage of Black Litterman, which is also called implied views, does this at the overall portfolio level. So this is the expected return on an asset class. This is the proxy that is appropriate for the risk-free rate depending on the investor. This is the beta of the asset class with the peer group. And this is the expected return on your peer group. So if you apply this, say, to Australian equities, you'll get an expected return on Australian equities given the beta of the equity class with the overall portfolio, which is set by a peer group average, times by the peer group market risk premium. You actually do this in Excel video number 4, which I'll give you in week 5. So I don't expect you to know how to do this yet. You will learn how to do it in a couple of weeks, and we're going to talk about it again then. But the fact is, it's a way of giving you returns that are in line with the risk. Then the second stage of Black Litterman is to look at it as an investor and say, well, all right, this is returns from a model. Is there anything that I disagree with? Do I really think that in actual fact, the implied views stage, or the first stage of Black Litterman, gave me a return on world fixed income of 8%, but I think it should be 9%, and I strongly believe that. Essentially, you just override it, right? You change it from 8 to 9%. So it's a way of also being able to incorporate investor views as well. But you need to do it carefully, because if you make too big a change away from those correctly aligned risk-return trade-offs, and you use Solver, Solver's going to jump to put more weight in the asset class with the higher return. So you're going to look at how to do that in Excel video 4. What I'll do is I'll finish the last slide in the workshop because I want to actually show you what that means while it's still fresh in your mind. I know I said I completely finished the lecture notes today, but I'd rather go through it in a bit more. Is everyone happy if would you rather me just finish the lecture notes quickly, or are you happy for me to show you an example? Example vote? Hands? Not example? Finish right away? I kind of led you to that answer, I'm sorry, but I didn't have the time. Okay, so the last couple of minutes, this is what you guys are going to do in week 5, Excel video 4. You're going to see, as you can see, you've got a beta for each asset class, which you will apply to an equation that is the CAPM, right? This is taking the risk-free rate times the beta, plus the beta times the market risk premium. That's going to give you an expected return on the asset class that you'll adjust your historical returns towards, and then you can override it if you like. So, for example, world equities unhedged, you've got a quarterly return of 2%. If you say, I actually think that should be 2.1%, you simply adjust it, and that affects all of the other returns. If I go back, well, where's my adjustment working? That's working there. Where's the actual mean? That's there and there. Hang on. Oh, maybe I need to be a bit more extreme. There we go. All right. So see, by adding an uplift of 1%, that's changed what I actually think the return's going to be. That's changed my adjustment factor that I'm then going to apply to my adjusted returns in this tab here. It's really hard to show you without you guys actually playing around yourself, but the point is all of that is going to feed into what you end up tweaking with your portfolio allocation. And you can do it in a parametric way as well. So that is going to happen in week 5. The last point is that you can, and you're not going to look at this method.